Hey, good afternoon. Welcome back to our market update where we have a lot to cover with jobs data and CPI really dictating the market movement here this week. My name is Brandon Steele, financial advisor with Mainsail Financial Group, and our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way, which certainly seems to be the case again here. A lot of noise lately with the Fed, what they may or may not do, and we're really going to break that down here in this week's update. Let's start by going back to last Friday. So we kind of shared last week that we would tip the cards a little bit on the non-farm payrolls number and that was going to be a really important data point to watch. And no surprise, it certainly was. So last Friday, the non-farm payrolls came out and we added 263,000 jobs last month, which is funny, right? Like that sounds like a good thing. Markets did not like it. Markets pulled back quite a bit. And I think the reason that we're seeing this is we're in this really weird good news is bad news type of environment right now because everybody's focus is entirely on the Fed. And I think what's really interesting to tip the cards before the inflation number that we'll touch on is that the market just seems to be speculating like crazy that the Fed is going to slow down and that they're not going to act as they're saying. They've been very clear about what they're going to do. And the market seems to not believe this time and time again. And so we see this speculation, the market picks up, and then a data point comes out that signals the Fed is going to probably continue to do what they said, and the market pulls back to where it was. So we're just getting a lot of volatility. It's not like we're seeing these giant drops overall, but we get a little optimism, and then we see it kind of pull right back. So I think that's something to really continue to watch. I think we're in this period where the Fed is going to do what they said they're going to do, and inflation is going to continue. And so we're likely to see that path really, continue as projected, I think. On Wednesday, we had FOMC minutes come out. They kind of shared the same thing. They basically suggested that they are going to continue as they said. I believe they might have mentioned that they will slow down when the time is right, but that time is not anytime soon. So similar story, but obviously everybody's hanging on every word to see if there's any cracks within that. All right. Now, all of that, jobs are very, very important, right? That as the job market is strong, the market feels like the Fed can be more aggressive. If we see the jobs market start to slow, that's where the market may feel like the Fed is not going to be quite as aggressive in their rate hike. But part two of that equation is inflation, because if that starts to pull back, then it's very likely the Fed will not be as aggressive either. Let's talk about that. So this week we had producer price index and CPI both come out. Yesterday, producer price index came out at 0.4% versus 0.2% expectations. Again, above expectations, obviously. But of course, the biggest thing that we've all been watching is the CPI data today. And the CPI data came out with 0.6% increase month to month, higher than expected, almost double what was expected, which was already expectations around growth. And I think what's really interesting to watch with this is that we're still seeing this extremely fast growth of inflation rate, even with energy prices really doing a whole lot of nothing over the past month or so. So I think that's really important to watch. We'll see obviously next month when the CPI data comes out again, but it's very likely the Fed's going to continue, and that's obviously going to dictate the path moving into the year end. All right, so with all that, we've got the Fed coming up. We'll have another CPI data before year end, or data point before year end. Obviously, jobs and inflation are really the two sides of that coin. So let's really pay attention to that, but be cautious of getting wrapped up in this speculation about the Fed movement until they project what they're going to do, because we just see this time and time again. It's happened all year. Where the Fed's kind of committed to knocking down inflation. Some data point comes out and everybody thinks the Fed's going to back off. Market picks up a little bit, and then of course we hear otherwise. So just be cautious in getting too wrapped up in that. With that, we'll transition to our question of the week, which is very, very timely. I've actually touched on this in the past, and I'll share a link maybe below as well with a little more detail from our blog. But the question comes from two people actually, which is why I wanted to cover it, David and Keith. So thank you both for asking about this. And the question is about inflation bonds or I bonds. Like what's the deal here? Are they worth looking at? And I think we're hearing a lot more about them now because obviously inflation continues to creep up. Plus, I think it's November 1st or the end of October where they will roll over again for a new rate. So for those who are not familiar, inflationary bonds or I bonds are basically an instrument of debt issued by the US government, okay? They are basically tied to a flat rate and then an additional rate that kind of follows the inflation rate that we're all tracking this year especially, right? So what happens is in periods of high inflation, you can get some pretty strong returns. In fact, I think right now they're paying a little over 9% on these I bonds. And so as you might imagine, especially with what's going on in the market, a lot of questions come up to try and find some solutions here and certainly look at I bonds as part of that equation. Now, what I want to share is that there's a lot of caveats to this. 9% sounds great, right? If we can get a US government guaranteed 9%, sounds amazing. But it doesn't work quite that simply. There's a lot more to this and a lot of restrictions in terms of how much you can buy, when you can buy, what you can buy, all that. So the first thing that I'll touch on is that I bonds are issued directly through the US government. There is no secondary market for I bonds. So when you buy or sell them, you need to buy them directly through the Treasury, all right? When you buy them, they're issued at a 30-year maturity. So they're actually meant to be there for 30 years. Now, if you wanted to sell them ahead of time, you certainly can, but again, you've got to sell them directly back to the Treasury. There's no market value necessarily with it. And there are certain periods or qualifications you must meet to get the interest. So there's a minimum holding period of 1 year. There's also a 5-year rule, which basically says if you sell it back to them anytime within that 5-year period, you'll lose 3 months, of that interest, okay? So that's really important to consider. I think another thing to think about is that although the rate may be really high right now, that could come down. So as inflation comes down, know that your interest payments are resetting every 6 months. So just to give you a hypothetical, let's say we're getting 9% today on these inflation bonds and you keep them for a year, but the next rollover drops to, I'm gonna exaggerate to make the point, let's say 2%, right? And you keep them for that full year, you haven't really gained 9%. You average that out and we're looking at, closer to what, 5.5, right? And obviously if that continues down, then your return drops with that as well. So that's really important to note. I think third, which is maybe most importantly, is we get a lot of questions about where this fits into a portfolio. How do we use this in a portfolio? And at the end of the day, this is probably not the greatest solution for a portfolio because you're limited on how much you can buy. You can only buy up to $10,000 a year and an extra $5,000 through a tax refund. So really, let's say $15,000 at the absolute maximum is what you can purchase per year in inflationary bonds. So don't get me wrong, I bonds certainly have a place. They can be very helpful as maybe a CD alternative or something along those lines, but you need to be very cautious, know the restrictions and what that means as far as your potential return moving forward. Make sure it's not money that you might need within the next year, and also consider, how that rate of return may stack up over the years, as well as your limitations in terms of how much you can buy in any given year. So I hope that's helpful. Again, got it from 2 people this last week, so it was a really timely thing to touch on, especially before the rate ticks over here at the end of the month. So thank you so much, David and Keith, for submitting the question of the week. If you have any questions for us, definitely let us know. We'll be happy to cover them in our Thursday updates. In the meantime, have a great upcoming weekend. I am actually heading to Florida for kind of a long weekend trip. So although we're sunny here in the Pacific Northwest, it'll be nice to get a little warmth there as well. So have a great weekend. We'll see you next Thursday at 3.